lot of people, what they do is they go out and they open up a Robinhood account and then they buy whatever's hot on Robinhood. They see a stock is blowing up on Robinhood and then they go and buy, and then they wonder why they lose money on it, because they buy and then it starts going down, and then they sell because they get scared, and then they don't understand why investing only works for the rich and how it's rigged and how Wall Street is controlling the game. But you're doing it completely wrong. Because you got to start by understanding what you're doing when you're investing. Because first you have to understand the difference between trading and investing. Trading is when you go out and you try to find a stock that you can flip in 3 months, 6 months, or 9 months. That you're finding this company that you think is going to go up in the next few months and then sell it for a quick profit. That is like gambling. I don't trade. I don't know how to trade, and well, you can make a lot of money very quickly with trading, but you can lose that money just as fast. I only talk about investing. Investing is now, instead of trying to find this quick flip, what you're looking for is a company. You're investing in a business. Because when you go out and you buy one share of, say, McDonald's, you become one of the owners of the McDonald's company. The McDonald's company, along with every other company that trades on the stock market, is broken up into shares. So if this circle depicts the ownership of McDonald's, it's broken up into many small slices called shares. At the time of recording this video, McDonald's has something around 720 million shares out there. So if you go out and you buy one share of the McDonald's stock, you become one of the owners of the McDonald's company. Now you own 1/720 millionth of McDonald's. What does that entitle you to? That entitles you to some of the profits of the McDonald's company, of the McDonald's corporation. So what does that mean? As McDonald's starts to make more money, the stock price might start to go up. Why? Because other investors might say, oh, this is a valuable company. Their profits are growing. Their revenues are rising. They're expanding in more locations. So I want to own this stock, and then the stock price starts to go up. That's one way that you can make money. It's called appreciation. Now, you don't actually make any money until you sell. So let's just assume that you bought a stock for $200 a share. It goes up to $400. You don't actually make any money unless you actually sell. But when you sell, you also have to pay taxes. But you got to understand that when a stock goes up, you don't make money. And when a stock goes down, you don't make money. You only make money when you sell, and you only lose money when you sell if the stock is down. But the second way that you can make money is some companies like McDonald's pay out what's called a dividend. And a dividend is when McDonald's makes a lot of profit, which they do, and then they can take this cash and do one of three things. They can save this cash for an emergency. They can take this cash and open new stores, open new franchises, invest in new technology, hire more employees, which they also do, or they can take this cash and give it away to their shareholders. Remember, they have 720 million shares out there. If you own one of those shares, you are a shareholder of the McDonald's corporation. And so now when McDonald's makes billions of dollars in profits and they don't know what to do with it, they can just give it away to the shareholders. Now, how do they give it away? In the form of a cash payment called a dividend. Dividends are generally paid out once every 3 months, meaning once every quarter, and this is cash they just deposit into your bank account for doing nothing except owning the company. And this is where now you can get some of that profit for just owning the company. So how do you get paid as an investor? You get paid now because you own some of the ownership in the company, and you get your share of the profits through things like dividends. Now, we got to be practical. If you invest $100 into the stock market and a company is paying you a 3% dividend, that means for every $100 you invest, you're making $3 a year in cash flow. Not anything significant. But the goal isn't to invest $100 one time and call it quits. The goal is to invest money every week, every 2 weeks, every month, month after month, year after year, decade after decade, and that's how you start to accumulate more and more wealth and more cash flow through any of your investments. But you have to know what it is that you're going to invest in. You have to know what is a good investment and what's the right strategy for you. And this is where things get a little bit more difficult, because most people are just looking for the next hot Nvidia, the next hot Amazon, the next hot Tesla, right? The hot stocks, the buzzy stocks. But if you're hearing about it on the news, then you've already missed the big bull run, the big rush. And if you really want to be able to find the opportunities, this is where you have to get a little bit deeper and granular in understanding your own financial education. And this is where I want to break it up into a few different questions that I want you to understand. And number one is understanding, what is your goal as an investor? Meaning, do you want to be an active investor or a passive investor? And an active investor is not a trader. An active investor is someone who's going to invest in individual companies like the McDonald's company. or the Amazon company. Because now you're looking for an individual company that you believe is going to be worth more money in the future, that you believe is innovating, that you believe that the profits are going to grow. Because if you believe that a company is going to make less money next year, you don't want to invest in that. You want to invest in a company that's going to make more money in the future. That way it makes you more money. But the alternative to that is being a passive investor. And a passive investor is somebody who's not investing in individual companies. They're investing in a fund. And I'll wipe this off to show you what I mean. Now, as a disclaimer, everything that I talk about is just for example purposes. I'm not telling you what to invest in. So we were just talking about investing in something like the McDonald's stock, which has a ticker symbol of MCD. So if you wanted to buy McDonald's, you can go onto your stock brokerage account and buy 1 share of MCD. But the alternative is to invest in a fund. And this fund might own shares of something like McDonald's. It might own shares of Amazon. It might own shares of Apple and 100 other companies. So now what you do is you're buying this fund as opposed to one company. Now the advantage here is if you don't know how to read the McDonald's financial statements, if you don't know how to read the income statement, the balance sheet, the cash flow statement, if you don't want to listen to the earnings statement, if you don't want to keep up with the company and study the company, you might not want to invest in the individual company. In fact, what I say is 98% of Americans should not be investing in individual companies because most people have no idea what the heck they're investing in. They don't want to do the research and they don't know how, which is okay. You don't have to. But the alternative is you can just invest in a fund. Now, there's a few different types of funds. You have index funds, mutual funds, ETFs. All 3 of these work similarly with some nuanced differences. But they all work the same in the sense that they are all different types of funds or baskets of companies that you invest in. And there are funds for anything and everything that you can imagine. I mean, just do a quick Google search. There are funds that give exposure to healthcare, technology, real estate, to India companies, Chinese companies, international companies. So there are a lot of different funds out there. I'll give you a few to start your research with. Again, I'm not telling you what to invest in, just giving you a few examples. So for example, there is an ETF, a fund called VTI. If you go and invest in this one ETF, you're getting exposure to the total stock market. So instead of investing in every stock out there, you can invest in this fund and get some exposure to the United States stock market. There's another fund called SPY. This gives you exposure to the S&P 500. The S&P 500 is a group of the 500 largest companies on the stock market. So now, instead of going out and investing of all 500 companies, you can just invest in a fund like SPY. There's a fund called QQQ, which gives you exposure to the NASDAQ. You might have heard of this index or group of companies called the NASDAQ. Well, if you want to invest in it, you can just invest in a fund called the QQQ. So there's a lot of different funds out there. The key is just understanding what it is that you want to invest in. And this is where it's important for you to keep up with what's happening in the financial news, but even more than that, the financial trends, because that helps you understand where is money going, where are consumer habits going, and where are behaviors going, because you want to be investing in money where the money is going. You want to be investing in an industry that's growing in the next 2 years, 10 years, 20 years, not that's going to be bankrupt in the next 10 years. And this is where it's important for you to understand not just the financial news, but also the financial trends. And this is where my company, Briefs Media, works to keep you up to date with this. We have a free newsletter called Market Briefs that breaks down what's happening in the financial news. It's completely free. If you haven't joined Market Briefs yet, I got the link for you down in the description below. It's a super fun to read newsletter. You can read it in less than 5 minutes every morning, and I promise you're going to love it. And if you don't, well, you can unsubscribe at any time because it's free. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.